The next great financial crisis probably won't be a surprise. In fact, it's being engineered right out in the open. The very lifeblood of our economy, liquidity, is vanishing at a record speed, and it's pushing our entire financial system toward a cliff. While most people are understandably worried about the crash, they're missing the real story. They're missing the end game. This crisis, this carefully managed tightening, is setting the stage for Bitcoin's most explosive move in its history. In this video, we're not just talking about another market downturn. We're going to break down the mechanics of this looming liquidity crisis step by step. We'll reveal the trap central banks have set for themselves and explain exactly why their only way out leads straight to a new financial reality with Bitcoin right at the center. This isn't just another crypto video, this is a look at the future of money itself. Right now, the market feels like a calm ocean on a sunny day. Stocks are hanging near all-time highs, the headlines are cheering on a resilient economy, and the consensus is that we've dodged the inflationary bullet and are cruising toward a soft landing. But just beneath that calm surface, powerful, unseen currents are building. A huge shift is happening, and it all comes down to one of the most important but least understood concepts in finance: liquidity. So, what is liquidity? The best way to think about it is like the oil in your car's engine. It isn't the gas. That's the economic activity, the innovation, the work people do. Liquidity is the lubricant that lets all the moving parts of the financial machine work together smoothly. It's what lets banks lend to each other, companies make payroll, and you sell a stock and get cash for it instantly. When there's plenty of liquidity, the engine runs hot and fast. Asset prices soar, getting a loan is easy, and the economy feels like it's on fire. But when that liquidity dries up, the engine starts to seize, transactions get sticky, credit gets tight, and the gears of the whole system begin to grind to a halt. For the last 15 years, since the 2008 crash, the world has been swimming in liquidity. Central banks, led by the US Federal Reserve, answered every single problem with one solution: open the money spigots. This policy, called quantitative easing, QE, was like pouring gallon after gallon of oil into the engine. It was a short term fix that created a long term addiction. The system didn't just get used to all this cash, it became completely dependent on it. Stock valuations, corporate debt, even government spending, it was all built on the assumption that the cheap money would flow forever. Well, it won't. In fact, the flow has already reversed, and that's the core of the problem we're facing. The tide is going out, and we're all about to see who's been swimming naked. To really get the crisis we're heading into, you have to understand the crazy experiment we're just now coming out of. The 2008 financial crisis was Act 1. To stop the banking system from completely imploding, the Fed fired up its first rounds of quantitative easing. It bought government bonds and mortgage-backed securities from banks, injecting trillions of brand new dollars into the system. This squashed interest rates and pushed investors into riskier things like stocks and real estate, sparking the longest bull market in history. Then came 2020. The world economy was shut down on purpose, and in response, central banks unleashed a monetary tsunami that made 2008 look like a ripple. The USM2 money supply, a key measure of cash in the economy, went vertical. From early 2020 to its peak in 2022, the money supply grew by an incredible 40%, an unprecedented expansion that has since started to contract. This wasn't just pouring oil in the engine, it was hooking a fire hose to the oil cap and letting it rip. The Fed's balance sheet, its own ledger of assets, ballooned from about $4 trillion to almost $9 trillion. This had two predictable results. First, a wild surge in asset prices. Stocks, real estate, crypto, even fine art, everything went parabolic. Second, and much more painful, it triggered the highest inflation we'd seen in over 40 years. Faced with soaring prices that were crushing regular people, the Fed had no choice but to slam on the brakes, and they did it with a force we have never seen before. This brings us to right now and the policy of quantitative tightening, or QT. It's QE in reverse. Instead of buying assets, the Fed is letting them expire, effectively deleting money and pulling liquidity out of the system. The Fed's balance sheet has already shrunk from its peak, and as of late 2025, it's estimated to be around $6.6 trillion. This process has been draining the reserves that banks rely on. Think of it this way. The fire hose is off, and it's been replaced with a giant siphon that is sucking the lubricant out of the economic engine month after month. The goal is to fight inflation, but there's nothing normal about draining liquidity this fast from a system that was made incredibly fragile and over-leveraged by 15 years of easy money. This isn't a controlled demolition. It's like pulling a load-bearing wall out of a house of cards. When liquidity vanishes, it doesn't happen all at once. The stress shows up first in the hidden corners of the financial system, in the plumbing that most of us never see. These are the canaries in the coal mine, and right now, they're starting to look very sick. The first and most important canary is the Fed's reverse repo facility, or RRP. It sounds complicated, but it's really just a place for big financial firms to park their extra cash overnight with the Fed. During the peak of all that money printing, the system was so flooded with cash that the RRP swelled to over $2.5 trillion. It was a giant, stagnant pool of spare liquidity. But over the last year and a half, that pool has been dramatically drained. As of late 2025, the balance in the RRP has plummeted, at times falling well below $100 billion. Why does this matter? Because that huge RRP balance was a shock absorber. As the Fed's QT started pulling liquidity out, the market could just draw from this spare pool. Now, that buffer is basically gone. The QT siphon is no longer sucking up stagnant extra cash. It's now pulling directly from the active reserves that banks need to function day to day. We've gone from draining the overflow tank to draining the main reservoir. The second canary is the banking sector itself. Remember the regional bank blowups in March 2023? Banks like Silicon Valley Bank went under because rising interest rates crushed the value of their bonds. To stop the bleeding, the Fed launched an emergency bailout program called the BTFP, a clever trick that let banks pretend their devalued bonds were worth their full price. But that program ended in March 2024. The safety net is gone, but the original problem, billions in unrealized losses on bank balance sheets, is still there, hiding just below the surface. The third canary is commercial real estate. High interest rates plus the post-pandemic work from home trend have created a perfect storm for office buildings. Vacancy rates are sky high and property values have tanked. The big problem is that hundreds of billions of dollars in commercial real estate debt is due to be refinanced in 2025 and 2026. These loans were made when interest rates were zero. Now they have to be refinanced at much higher rates on buildings that are worth far less. This is a recipe for a massive wave of defaults. And the lenders on the hook are often those same regional banks that are already in trouble. The canaries are telling us the system can't handle this much tightening. The engine is running out of oil, and you can start to smell the smoke. This tightening would be bad enough on its own, but it's happening against the backdrop of the single biggest financial vulnerability of our time, government debt. The US government is on a completely unsustainable path. As of late 2025, the national debt has surged past a staggering $37 trillion. That number is so big, it's almost meaningless, but the debt is growing by billions every single day. The government is spending nearly $2 trillion more per year than it brings in, and it has to borrow that money by selling treasury bonds. Now, connect this to the liquidity crisis. Who is supposed to buy all these trillions in new bonds? For years, a huge buyer was the Fed itself during QE. Other big buyers were foreign governments and our own commercial banks who were flooded with all that QE cash. You see the collision course, right? At the exact moment the Treasury needs to sell a historic amount of debt to fund its spending, the Fed is doing the opposite. It's pulling cash out of the system with QT. The banks, which are supposed to buy this new debt, are having their own reserves drained by that very same QT. This creates a terrifying feedback loop called a debt spiral. The flood of new treasury bonds overwhelms the market. To find buyers, the government has to offer higher and higher interest rates. But those higher rates have devastating effects. First, they make the government's own debt problem worse. Interest payments on the national debt are already on track to surpass $1 trillion a year, rivaling what's spent on national defense. Higher rates make that number climb even faster, meaning we have to borrow even more money just to pay the interest. Second, higher rates crush the economy, making mortgages and business loans more expensive. This is the Fed's trap. It's caught. On one hand, it has to keep fighting inflation. On the other hand, its policies are squeezing the financial system to its breaking point, all while the government needs to borrow record amounts of money. The Fed is trying to put out the inflation fire, but the hose is connected to a tank of gasoline, the national debt. Something has to give. Okay, we are deep in the weeds now, and if you're still with me, you get how serious this is. This isn't just some abstract theory, it's the roadmap for the next chapter of our financial lives. If you're getting value from this breakdown, take a second to hit that subscribe button. It costs you nothing, but it ensures you won't miss the critical updates as this all unfolds. We're navigating this together, and my goal here is to give you the clarity you need. Now, let's talk about what the Fed will do when this trap finally springs shut. So, what happens when an unstoppable force, the treasuries need to borrow trillions, meets an immovable object, the Fed's tightening policy? Simple. The immovable object moves, the Fed will be forced to pivot. It's not a question of if, but when and what has to break to make them do it. This is the core of the thesis. You could even call it a manufactured crisis. That doesn't mean a conspiracy, but that the outcome of the Fed's current policy is so predictable that the crisis is essentially a planned consequence. The people at the Fed aren't stupid. They see the stress in the markets, they know about the bank reserves, they see the commercial real estate time bomb. They are tightening the screws until something audibly snaps. Why would they do this? Why not just back off now? Credibility. After telling everyone inflation was transitory and then being forced into the most aggressive rate hikes in history, the Fed can't look weak. It needs a bulletproof reason to pivot, a crisis so bad that nobody can question their decision to ride to the rescue. That reason will be a financial crisis. Maybe a big hedge fund blows up, maybe a flash crash hits the stock market as liquidity vanishes. Most likely, a major credit event happens, another bank fails, or defaults in commercial real estate start a domino effect. It will be an event so dangerous to the system that the Fed can step in as the hero, the firefighter putting out the blaze its own policies helped start. And when that break happens, the response will be fast and massive. The pivot will come. First, QT will stop on a dime. Second, interest rates will be slashed aggressively. And third, the Fed will launch the next and likely the largest round of quantitative easing we have ever seen. The money printers will roar back to life, not to help the economy, but to liquefy a financial system that has frozen solid. They will be forced to buy the government's debt. This is the end game. They tighten until it breaks, then use the break as political cover to unleash an unimaginable flood of new money. And in that one moment of saving the system, they will openly sacrifice the value of the dollar. This is when the quiet, creeping debasement of our money becomes loud, obvious, and undeniable to everyone. This is the moment the ultimate catalyst is triggered. This is the question every single person will be asking themselves when the Fed pivots. If our money is being deliberately devalued, where on earth do we put our savings to keep them safe? For thousands of years, the answer was gold. When governments abused their currencies, people ran to the safety and scarcity of gold. It's the original sound money. It's durable, divisible, and most importantly, its supply can't be doubled overnight by a committee. The sheer effort of mining keeps its supply growth slow and predictable at about 1 to 2% a year. This is why it has preserved wealth through the collapse of countless empires. The conflict in our financial system is between two types of money. On one side, you have fiat currency, like the dollar or the euro. The word fiat means by decree. It's money that only has value because a government says it does. Its supply is infinite. On the other side, you have sound money or hard assets, things whose supply is constrained by physics or math. Gold is the classic example. The Fed's coming pivot will be the clearest sign in our lifetimes that the fiat experiment is failing. When a central bank has to print trillions of dollars just to stop an immediate meltdown, the game is up. It will become painfully obvious that the cash in your bank account is a melting ice cube, and you need to get your wealth into a lifeboat. Gold will certainly be one of those lifeboats, but in the 21st century, a new, more powerful option has shown up, a digital answer to this very old problem. If gold is the analog store of value, Bitcoin is its digital successor, built for the internet age. It takes the best qualities of gold and supercharges them with math and decentralized computing. When you look at Bitcoin through the lens of the crisis we've just laid out, you see why it's perfectly designed for the world we're heading into. Let's connect its key features directly to the failures of the old system. First and most important is absolute scarcity. This is Bitcoin's superpower. While gold is scarce, we can always find more of it. Bitcoin's supply is mathematically and provably capped at 21 million coins. That's it. No more will ever be created. Period. Now compare that to a central bank that can create trillions of dollars with a few keyboard strokes. When the Fed is forced to pivot and print, the contrast between a currency with an infinite supply and an asset with a finite one will be the most important financial truth in the world. As the supply of dollars explodes, Bitcoin's fixed supply makes its rise in price a mathematical necessity, not a speculation. Second is decentralization. The US dollar is controlled by the Fed, the euro by the ECB. Bitcoin has no central authority. It's run by a network of thousands of computers all over the world, all enforcing the same rules. There's no CEO to lean on, no headquarters to raid, and no committee that can change its monetary policy on a whim. In a world where trust in our institutions is breaking down, Bitcoin offers a system governed by rules, not rulers. It's the ultimate insurance policy against the mistakes and temptations of central bankers. Third is verifiability and portability. You can verify the entire supply and transaction history of Bitcoin on your own computer. You don't have to trust anyone. Even better, you can send $1 billion worth of Bitcoin across the world in minutes with almost no fee, and no one can stop you. Try doing that with $1 billion in gold bars. This blend of digital scarcity and unstoppable portability makes Bitcoin the perfect asset for our digital world. It's wealth you can truly own with no strings attached. The old system is built on trust in politicians and central bankers. That trust is being destroyed by debt and reckless policy. Bitcoin is the alternative, a system built not on trust, but on mathematical proof. It is the escape hatch. All right, let's connect all the dots. This isn't just a bunch of random events. It's a chain reaction that leads directly to a repricing of Bitcoin. Step 1, the setup. 15 years of easy money policies created a global financial system addicted to cheap liquidity. Step 2, the tightening. To fight the inflation it caused, the Fed starts the most aggressive tightening cycle in modern history. Step 3, the squeeze. This tightening drains liquidity from the system's weak points. The RRP buffer is gone, banks are wobbling, and commercial real estate is on the verge of defaulting, all while the US government tries to borrow record sums of money. Step 4, the break. The pressure becomes too much. Something in the financial plumbing snaps. A credit event, a market crash, a banking crisis. It doesn't matter what. This is the predictable crisis the Fed needs to justify its next move. Step 5. The pivot. Using the crisis as air cover, the Fed abandons tightening. It slashes rates and launches a massive new QE program to save the system by printing money. Step 6. The catalyst. This pivot is the ultimate catalyst. The act of creating trillions of dollars to bail out the system is a global advertisement for Bitcoin's scarcity. The debasement of money is no longer a slow creep. It's now an overt, explosive policy. Big money, institutions, corporations, wealthy investors will be forced to find a safe haven. They will see the melting ice cube of fiat money and run towards a non-sovereign, scarce digital store of value. This is what happens when a tidal wave of new demand hits an asset with a perfectly fixed supply. The price of Bitcoin doesn't just go up, it fundamentally reprices against the debased currencies of the world. This won't be a speculative craze, it will be a flight to safety. It's the moment the world figures out that in a system where everything can be printed, the one thing that can't becomes the most valuable asset of all. The coming liquidity crisis isn't a threat to Bitcoin, it's the event that will prove its entire purpose to the world. As big as this is, it's worth zooming out. This isn't just about one market cycle. We're witnessing the early stages of a fundamental shift in the global financial order. The system we've had since 1971, built on the US dollar, is showing terminal signs of decay. The dollar's dominance gave the US an exorbitant privilege, the ability to print the money the whole world needs, allowing it to spend far more than it makes. But that privilege is now being abused to its breaking point. The massive US debt and the use of the dollar as a financial weapon are forcing countries everywhere to wonder if it's smart to hold their savings in a currency that can be devalued at will by one country's central bank. We are moving into a world that will eventually demand a neutral, politically agnostic reserve asset, an asset not controlled by any single country. Historically, that was gold. But today, a digital, global, and perfectly scarce asset like Bitcoin presents a very compelling alternative. The coming crisis will simply accelerate this shift. It represents the separation of money from the state. Just like the internet broke down monopolies on information, Bitcoin is breaking down the monopoly on money. It offers a global, open source monetary network that anyone can join, an escape from the closed, top down systems we live in now. This isn't to say Bitcoin replaces the dollar tomorrow. That transition will be long and messy, but the direction of travel is clear. The coming liquidity crisis and the Fed's response will be a wake-up call for the entire world. It will expose the weakness of a debt-based system and highlight the strength of a decentralized one. This is the big picture. We're not just watching a bull market unfold, we are witnessing the birth of a new kind of money. Let's quickly recap. We started with today's false sense of calm and uncovered the powerful currents of vanishing liquidity. We saw how the money printing of QE led to the painful draining of QT. We identified the canaries in the coal mine, the empty RRP, shaky banks, and the commercial real estate time bomb, all screaming danger. We exposed the trap the Fed is in, caught between fighting inflation and propping up a system drowning in government debt. We've laid out how the only way out is for the Fed to pivot and unleash a new flood of printed money once something inevitably breaks. And that very act, the massive open devaluation of currency, is Bitcoin's ultimate catalyst. It will trigger a global flight to safety, a desperate search for an asset that can't be printed and isn't controlled by anyone. This crisis isn't a headwind for Bitcoin, it's the tailwind that will launch it onto the world stage. The coming crisis isn't something to fear, it's a signal that the era of central bank magic and endless debt is ending. In the world that's coming, it won't be the shifting whims of a small committee that define value. It will be the fixed, unchangeable rules of mathematics. If you want to stay ahead of these massive trends and get the kind of analysis that helps you navigate this shift, make sure you're subscribed. In the world we're heading into, the quality of your information will be everything. And now I want to hear from you. Drop a comment below. Which of the canaries, the banking sector, commercial real estate, or the bond market, are you watching most closely right now? Let's keep this conversation going. Thanks for watching.